There are quite literally tens, hundreds, thousands of different financial metrics that you can use to try and evaluate a company, and it can be really intimidating, cause you to suffer from analysis paralysis when trying to invest. So, if I could choose just one financial metric to decide where should I invest, where shouldn't I? Where's a company that's getting better? Where's one that's on the downfall? This video is going to talk about what that one metric would be. My name is Brian Stoffel. I want to give a shout out to the sponsor of today's video, fiscal.ai. You'll see a whole bunch more coming from them in just a minute. But let me just start out with a question. If I asked you, would you know the difference between a gross profit margin, an operating profit margin, and a net profit margin? They're all important. But this video is going to focus on what I think is the most important one, and I'm going to explain why, and that is the gross profit margin. Now, to explain why the gross profit margin is so important, it's helpful to just kind of look at an income statement and what it is. Now, of course, we know the time period is on the top. We've got to pay attention to that, but we're going to use an example to show why gross margin is so important of something very simple everyone can relate to: a lemonade stand. Now, at the top of an income statement is sales or revenue. That's the amount of money I collect from running my lemonade stand. After that, you have the cost of goods sold. Now, what is included in the cost of goods sold? Well, think of it this way: it's basically the cost of whatever it is that I hand over to the people coming to my lemonade stand. So, the cost of the lemons, the sugar, the water, the cups, the straws, and importantly, you only include the cost of the lemons that were used, the sugar that was used, the cups that was used. If you've got more sitting underneath your lemonade stand, that doesn't count in cost of goods sold. That's another story for another time. But that's what you include. And when you subtract the cost of goods sold from the revenue, what you get is gross profit, not gross profit margin, but gross profit. Here's why gross profit is so important. Most people that are probably watching this video come from a society that is capitalistic, which has its pluses and minuses. Well, in societies like this, if you have a product that does really, really good, you're going to have a lot of success. You're going to probably collect a lot of profit, which for you is usually a very good thing. Now, the thing about capitalist societies is that then competition can come along. Now, that's really hard on you because if you do really well, you're going to attract attention. And that attention can end up killing you because the competition can come in and offer, say, lemonade that's just as good for slightly less. That's really great for lemonade lovers around the world, but really terrible for lemonade stand vendors around the world as well. The only way that you can keep the competition at bay over a long enough time frame is if you have a moat, which is a sustainable competitive advantage, something that we've already made a lesson on this channel. Now, the moat is most visible by looking at, you guessed it, the gross profit margin. Now, why is it just this and not the other parts? Well, the next line item down in an income statement are operating expenses. This is things like how much you spend on your administrative budget or your sales and marketing team or your research and development. And while all those things are important, they're things that you, the business, largely has control over. And if we want to know whether or not you have a moat, that's not going to tell us. It's going to go back to the gross margin. Why? Because the market and your customers are really what decide whether or not you have a moat, not your R&D budget per se. So how do we calculate gross profit margin? Well, this is great because it's elementary school level math. You simply take the gross profit and you divide it by the total revenue. So in this case, the revenue is the amount of money that you collect from running your lemonade stand. Let's say you have $100 in sales per hour. And the cost of goods sold during that hour is about $50. You spent $50 on the lemons and the sugar and the water and the cups and the straws that you used. So you subtract 50 from 100 and you get $50 in gross profit. And you plug that in and you divide 50 by 100 and you get a gross profit margin of 50%. In other words, for every dollar in sales that you hand over in your lemonade, you get to keep 50 cents as gross profit. Not bad. But let's just say that the neighbor comes out and she's smiling and she's got a better sign and her lemonade is pink and she attracts attention. These are the forces of capitalism at work. Now, one of two things is going to happen if you don't have a moat. Either you're going to sell less lemonade at the same price because she's right there selling it, or you're going to sell the same amount of lemonade, but to compensate for that competition, you're going to lower the price. So let's see what that would look like. Now you've gone and you're selling the same amount of lemonade, let's say, but you have to lower your price. And so you're only collecting $90 per hour, but your cost of goods sold remain the same, meaning you have gross profit of $40. And look at this, your gross profit margin just went from 50 to $40, 50% to 44%. So what's our verdict? A moat is highly unlikely. Now let's just say somehow you do have a moat. Let's say you have relatives who have a lemonade farm in a warm climate and they send you those lemons for free. And so your input costs are lower. So you have a low cost production moat and you can offer that lemonade, which is just as good for less. Or let's say you ran into a burning building and saved a whole bunch of people and their pet fish. And so you're a local celebrity. You have a brand moat, or you have a loyalty program. You might have a switching cost moat. So what are some signs that are going to show up if that's the case? Well, you'll probably still be selling just as much or more lemonade despite that stand opening up next to you, or you can keep your prices the same or higher than that other lemonade stand. Let's just say that you have an exclusive agreement with the best lemonade farms period in the world, and you're the only one who can buy them from there. Of course, this is unrealistic, but it's a demonstrated point. Now, you're willing to spend a little bit more for those lemons. So you spend $60 for an hour's worth of lemonade that's sold, but you're going to raise the price because no one else can get these lemons. You have an exclusive relationship and people are willing to pay for that. So they'll give you $130 per hour. Now, your cost of goods sold was higher, but your revenue increased even more. Your gross profit was $70 and your gross margin went from 50 to 54%, even though you've got competition. And so our verdict is, well, now a moat is really likely. Let's take this out of the realm of hypothetical and move on to a real life example. Whole Foods, company that I invested in a long time ago, over a decade ago. Something funny happened during the global financial crisis. Everyone else who was getting into natural and organic goods immediately stopped. Why? Because everyone was worried about whether or not modern society's financial sector was going to melt down. And guess what? They weren't willing to pay twice as much for an organic pear or banana as they were before. Now, everybody else abandoned those things. Whole Foods couldn't because that was what they were all about. The flip side of that is that once the recovery set in, if you all of a sudden were now willing to pay a little bit more for those organic oranges or bananas, well, guess what? There was only really one place you could go, Whole Foods. And so it's not surprising that as that recovery set in and as people felt a little bit more comfortable buying those things, Whole Foods being the only place where you could get those things writ large, the stock went up 500% in 4+ years. Amazing. And it's not surprising that the gross profit margins expanded significantly, up 154 basis points during that time as well. Now, you might think it's a small deal to go from 34.3 to 35.84%, but that's actually a huge deal. It means Whole Foods was able to raise prices relative to their input costs, and people were willing to buy it. But just like the chart I showed you about the forces of capitalism, the success that Whole Foods had attracted attention. It attracted Costco and Kroger and Sprouts Farmers Markets and Walmart to say, I want a piece of that. And they formed their own private label brands. And so the question now then became, does Whole Foods have a moat? Well, they don't really have network effects. Me going doesn't make for a better experience for that other grocery shopper. In fact, it's probably worse. They have longer lines to wait in. They don't have a low cost production because they can't lock up all the natural and organic farmers in the world. That's impossible. They didn't really have counter positioning because these companies were able to get into natural and organic goods really quickly. And they didn't really have switching costs or any rewards program. So the question became, does Whole Foods have a brand that is going to make it so that people are willing to continually pay more for natural and organic goods at Whole Foods when they could get them for the same at less at a Costco, Kroger, Walmart, what have you? The answer was no, and the stock fell 54%. But more importantly, as soon as those competition came in, look at what happened to Whole Foods gross margins. Not only did they fall, but they fell to below where they were in 2009. They contracted by 217 basis points, which is why it did not end up being a great investment. Now, how can you research this yourself? Well, for that, we head on over to Fiscal AI, the sponsor of today's video. Clip that top link in the show notes below, and you can go to the website and check this out. And if you want a full membership, by using that link, you will get 15% off 1-year subscription to fiscal.ai. So thank you to them for sponsoring today's video. So if we head on over there, I've typed in Beyond Meat. Now you see what Beyond Meat has done as a stock. It's just gone down and down and down and down. It was once trading for as high as $178 per share. Now it's under $1. And if you want to see why, look no further, click on financials here, and we go to gross profit margin. Look at what has happened to the company's gross profit margin. It was as high as 33%. So for every dollar in plant-based meat that they sold, they got to keep 33 cents. For a period of time, it actually went negative. Think about what that means. For every dollar in plant-based meat that they sold, they lost $1.25. And even though it's recovered, it's much, much lower than it was before. Other people have come in and offered the same thing for the same or lesser price, and that has absolutely obliterated Beyond Meat's gross profit margin, which is why the stock has returned what it has. What's one of the most impressive stocks to have owned over the last 15 years? Amazon. Amazon is. If we look at their stock chart right here, if you go back to even 2012, you could get it for $12 split adjusted per share, and it's up to $220 today. Now, unsurprisingly, if we head on over to financials and then we click on gross profit margin, look at what we see. This is something that you're not going to see almost anywhere else. Back in 2010, Amazon's gross profit margin was 22%. Today, it's roughly 50%. You see it continually going up and to the right, with the exception for a little blip here when the pandemic happened. That is why Amazon has been such a winning investment. Now, you might be wondering, that's great, but how do I know if a company has a good gross profit margin? Well, lucky for you, I've got a cheat sheet just for you. But before I show you that cheat sheet, I want to tell you about a program that I've started. Now, I've followed my returns over the last 10 plus years. Mine are in the green, almost 7xing during that time, versus the NASDAQ composite in the yellow, the S&P 500 in the red. And I've used gross profit margins as a key way of selecting stocks. The name of my program is Stock Investing Mentor. And if you join, it has 3 main parts. The first, 1 hour of live weekly instruction similar to this on Thursdays at 12 noon, all recorded if you can't make it, where I teach you an investing nugget to help you become a better investor. Second, you get real-time access to my real-life portfolio. Whenever I make a move, not only are you alerted that same day, but you get a video explanation of why I made the move. And 24/7 access to a private, high-quality online investing community. If that interests you, second link in the show notes below, and you can get 10% off an annual membership. So here's the cheat sheet. If you're wondering, well, what is a good gross margin for me to look for? It depends on what industry the company you're looking at is in. For instance, automobiles, grocery companies, those tend to be lower moat companies. Okay, you can't get away with selling a banana for $50 if someone else can offer the exact same thing for $1. So those gross margins tend to be lower in the 20% range. Up a step from that are restaurants and entertainment that can be in the 30 and 40% range. Above that, railroads. Think about it. Railroads have a moat. You can't just build a railroad wherever you want. High-end consumer goods, telecoms, they're in the 50s and 60%. And then we get into the rarefied air, companies that really have a wide moat and low input costs, like software as a service, like social media. And then the cream of the crop are marketplaces like booking.com that have a 93% gross margin, and payment services like MasterCard that can even have 100% gross margin. So take a moment, take a screenshot of this so that you get it and can use it in the future. And if you enjoy things like that, don't forget to check out Stock Investing Mentor below. So what do you think? If you could just choose one metric and use that metric to make your investing decisions, what would it be? Put it in the comment section below. And if you want to become a better investor, don't forget to hit subscribe when the next video comes out. Until then, Brian